conversation today. As introduced, I'm Tushar Thakkar. I work with Dalberg in the Mumbai office, and I lead the work that we do around what is called innovative and blended finance. You would have heard this term thrown around a fair bit, and I'll attempt to maybe go into it a little bit, explain what it is, why is it being used, what are the sort of use cases for it, and what are some of the learnings from the initial few implementations that we've had so far. So broadly, I mean, as indicated, I think what this masterclass will cover is I'll start off with just a very sort of basic background around what blended finance actually is. Given that different people are at different stages of their journey in blended finance, it'll be fairly fundamental. However, in the second part of the discussion, I'll go into what have been some of the learnings that we've gotten from our implementation of a particular kind of an instrument. We do a lot of our work in what is called results-oriented financing. That's what we'll deep dive in. What have been the learnings? We've implemented quite a few transactions there. What has the experience been? And then time permitting, we'll talk a little bit about where this ecosystem is going. What I'll do is I'll try and, we have about an hour together, and I'll try and finish the prepared part of my presentation in about 30 minutes or so, and then happy to just have a conversation. Okay. Fantastic. So I'll probably start off with maybe just a quick background to Dalberg for those who haven't encountered us before. We are a strategy consulting firm, as I mentioned before, Dalberg Advisors. We are actually a platform encompassing 4 or 5 different organizations. We do consulting, which is the biggest part, and that is what me and my colleague Kaustav here are from. We have a small analytics team. We also do human-centered design. We are present, as you can see, across the globe, including a fairly strong presence across the developing world. At Dalberg, we focus on 13 different focus areas, which encompass everything that you might see in the development space. So Kaustav and I, we focus on the finance and investment, which actually cuts across all of these different areas. So with that out of the way, I will maybe dive into the content of the presentation a bit. So as I indicated, I think I'll start off with maybe trying to define what blended finance really is. Maybe starting off with why are we even having this conversation, right? The right side of the presentation is what you've already probably heard before. There is a significant need for developmental capital. The government's doing a lot, philanthropies are doing a lot of people in this room are doing a lot. However, the gap remains. And this gap needs to be filled through potentially trying to either access new kinds of capital. So how do we, for example, get private capital or sort of recruit private capital to participate in the development space more? Or how do we incentivize them to act in manners that actually drive developmental outcomes? That's one. And there could be other pools of capital as well. And the second is how do we get greater efficiency or more sort of outcomes orientation from the way we allocate or utilize our capital currently. So those are the couple of ways potentially in which we can try and bridge some of the sort of gap that you see in developmental finance. And this is where blended finance comes in. Blended finance is essentially at its very root, it's a set of tools and frameworks that are utilized to try and see if the pool of capital can be expanded, typically by bringing in private capital, and how do you use philanthropic capital or public money or other forms of development capital to actually incentivize private capital to come participate. Or how do you again use these tools or frameworks to get better outcomes from the same money that is being spent right now. So this is why we are having this conversation. This is what blended finance enables. However, and I'll keep coming back to this tools and frameworks framing again and again, because I think it's really important also to recognize that blended finance is not it is not the answer to every need in the developmental ecosystem. It has its limitations. It can be applied to a very specific set of scenarios. However, it does present a fairly powerful tool. Moving on to the next one, the attempt here is to actually try and situate blended finance within the spectrum of capital, right? So basically, if you what you see at the top here is essentially different types of capital that can be directed towards specific causes. to the extreme right, you have commercial investing, which is fully return-oriented capital. There is no intentionality in developmental outcomes there. And as you keep moving towards the left, you have ESG, where there's some intentionality, impact investing, where there is actually a little bit of a mix. And then blended finance sits in between impact investing and what is traditional philanthropy. Traditional philanthropy, here we are basically referring to what is primarily grant-led capital. So what currently is sort of a large part of the ecosystem. So blended finance sort of sits in between those and tries to bring in actors from both sides to try and typically use the philanthropic actors to try and see if the sort of actors on the investors on the other side can actually be made to sort of allocate more capital towards developmental goals. How it does that is basically by utilizing a number of different instruments. I've basically tried to give examples of different kinds of blended finance instruments that exist. And again, this is a non-exhaustive list. It doesn't necessarily touch upon everything that is out there. There's a lot of creativity, a lot of innovation happening in the space. However, it is just some illustrative examples of what we've tried to do here. What you see again on the right, for example, is concessional or long-term patient capital. Very simply, what that means is that philanthropic capital comes in to sort of set right the risk-return sort of trade-off for investors. So a lot of commercial investors don't invest in developmental outcomes because they perceive those areas to be too risky. So if a philanthropic capital provider were to come in and say, okay, look, I will, if your expected return is say 15%, however, this particular sector can only give you 12%, if I make up for that remaining return, then will you be willing to actually come participate? So that's one example, but there could be others as well. Next to it is a class of instruments which fall within guarantees or risk mitigation. Tries to do a very similar thing. It basically goes again, to private or commercial capital, and try to, for example, if there's a bank which sees significant risk of default, or there's basically significant risk seen in terms of how commercial capital might drive return, of philanthropic capital or developmental capital can come in and provide some sort of insurance or guarantee that in case you are unable to meet your return requirements, then we will sort of help you meet them. Where you see these being applied, especially the guarantees, are in areas where there is less data. So, for example, recently we were looking at how micro enterprises could get credit, and typically there's not a lot of data there. There's very little understanding of how to even evaluate micro enterprises for debt, and therefore guarantees can come in to help banks even take the leap into providing debt to micro enterprises. So there are various use cases which I'll talk about a few as we go forward. However, that's another one. Results-based financing will go into a little bit of detail, so therefore I won't spend a lot of time talking about that here. But results-based financing basically refers to sort of a set of instruments where payments are made upon achievement of outcomes instead of activities or inputs as grant capital is typically sort of provided, right? Where it is provided upon the completion of certain activities. In result-based financing, the objective is that money should actually be paid only once the outcomes that are targeted are achieved, and therefore there's a need for some complex structuring to happen to make sure that working capital continues to be available. And finally, technical assistance grants. I mean, this, at the face of it, is not really blended finance. TN grants are essentially squarely part of the traditional sort of giving paradigm. However, they can be very important enablers of blended finance. Again, to give an example here, we were recently looking to help catalyze private equity into humanitarian situations. And when you look at refugee camps, they are perceived to be highly risky, very fluid situations. Most investors don't really know what to do when they go into those areas because there's no set government, there are no set institutions. And therefore, philanthropies are envisaged to play an important role in just helping either build those institutions or helping inform or do some capacity building with investors for them to understand where they're going to invest. So it's an important enabler, even though it is not necessarily sort of a blended finance instrument by itself. Moving on. So what does this all mean, right? All of these instruments have been now around for some time. It's been almost a decade or more since blended finance has been utilized. And if you think about how public capital is being blended, typically governments have been operating through PPP models, which are a form of blended finance, if you think about it, for a fairly long time now. However, if we look at the sort of instruments that I spoke about that are defined as blended finance, and excluding those PPP models, the funding towards those has grown quite substantially over the past decade or so, to the extent that I think over the past 12 years, approximately $5.6 billion of capital has actually gone through blended finance transactions. And then there have been a fairly large number of actors, as you can see. I mean, there are a bunch of philanthropies and international institutions, but a number of sort of domestic institutions which have participated in these transactions as well. And where has this money gone? It has gone into actually a fair few sectors. If we have to look at just the capital allocation of it, sectors like education, sorry, not education, financial services and energy, along with water, sanitation and hygiene, have gotten most of this blended capital. However, this presents a slightly misleading picture because these are also sectors where transaction sizes tend to be large. If we look at the other chart where we've looked at number of transactions, you will see that there's a fair bit of diversity. Sectors like livelihoods, sectors like health, agriculture have seen a lot of transactions happen in this space as well. Yeah, I'm probably going to skip through this quickly. However, a recent research report which was written by Asha Impact, which is a investing organization, also a think tank, looked at whether blended finance is actually meeting its objectives. Is it actually generating leverage? What they mean by leverage here is, if you invest $1 of philanthropic capital, how many dollars of private or non-traditional capital is being generated? And as you look at all of these have generated some quantum of leverage. Results-based financing close to 2.4 times. So every dollar of philanthropic capital has given about 2.4 times non-traditional or private capital, and then going all the way to the other end. Very quickly going into a couple of examples here of the kinds of transactions that have been implemented. These are two of the many transactions that have been implemented in the blended finance space. On the right, what you see is the Revive Alliance. It's a fairly well-known facility which was set up. It's a $20 million facility which was set up with the support of CSR, philanthropy, and overseas development assistance, which basically looks to provide returnable grants. Essentially, this provides micro grants to individuals who essentially then have the option of returning them subject to their incomes in the future. Therefore, there's a significant focus here on livelihoods. They have, they also do interest subvention and credit guarantees. Credit guarantees are for the returnable grant portion. This is where philanthropic capital actually comes in to enable this kind of an instrument. These are the kinds of segments like micro enterprises and also specific individuals which would otherwise never have gotten access to this kind of capital. However, CSR money and philanthropic money came in and has enabled for these kinds of micro loans to go to these individuals who can then, of course, return them depending upon their future earnings. So that's one example. It's a largish facility. I mean, $20 million is still not massive, but it's a relatively larger facility which has been set up through a blended finance approach. What you see here is a results-based financing one, and this is the one that, for example, Dalberg has been involved in. This is an impact bond. This is an impact bond which aims to transform the skilling ecosystem in India. As I think a number of you might be aware, the way skilling typically happens in India is that money is provided for training through philanthropy or through government capital, and there isn't necessarily a strong focus on figuring out whether these individuals are getting jobs or are actually being retained in those jobs once they complete their training. So what the Skill Impact Bond is aiming to do, and as I mentioned, we not only designed this but are helping run this as well, is to work with beneficiaries, especially women, in ensuring that they actually get these jobs and are retained in those jobs. So payments by philanthropic organizations are only made upon the achievement of those outcomes. So philanthropic organizations in this case do not pay for inputs. They don't pay for training. What they pay for is actual achievement of people getting jobs or people staying on in jobs. This has been enabled because private capital basically comes in to provide working capital to the implementing partners, and then philanthropic organizations then pay up on outcomes. So this is also $17 million facility. It aims to also support women largely. So the target is to have more than 60% of beneficiaries being women. And sort of the objective is because NSDC is a part of this particular of this particular construct. The objective is to then hopefully inform government programs that NSDC runs as well and transform the billion-dollar skilling ecosystem that we are now seeing. So I think with that, that was more of an overview of what blended finance looks like and the kind of instruments that we have. Maybe I'll spend just a few minutes talking through what have been some of the learnings from a decade of blended finance implementation. I'm actually maybe happy to pause here and answer any questions if anyone has. Maybe I can take a few questions right now if there are and answer those, and then maybe I'll move on to the next section. Yeah, sorry, I think there's one here. Yeah. Yeah, we have a couple of names here. So NSDC and the Dell Foundation are the investors there. So they are the ones providing working capital to the implementing partners, and the outcome funders. So the philanthropies are now actually, as I said, paying up on outcomes. Those are here. So there are two CSR organizations, JSW and HSBC, and two international philanthropies. So SIF and Dubai Cares are the ones who are paying up on outcomes. The returns for this are approximately in the 9 to 10% range. And of course, I mean, just to caveat that, that depends upon the achievement of outcomes. They don't get paid unless outcomes are achieved. So returns, the returns they get are for the risk that they take for the actual achievement of retention outcomes at that. Yeah. Yeah. So just to understand your question, you're essentially checking whether that the return which is over and above that is provided. Yeah, so in this case, I think it is because NSDC is also a developmental organization. They are actually plowing it back into programs. Just to highlight, it's possible that there could be an impact investor who acts as an investor as well. Now, if they get the return, then they would probably just be passing it back up to the people who are funding them. Yeah. No problem. Yeah. Sorry, this one, and then maybe here.
Hi, my name is Ankit. I would love to understand that when we're talking about the risk investors. So, for example, let's say traditional bank, and now they want to invest in development projects. Right?
Yeah.
A lot of banks, like Asian Development Bank, is now supporting affordable housing schemes, right? For example, or there are other organizations supporting other development projects.
Yeah.
Person two level questions. One is that what kind of scope an education project holds, especially from the interest of a risk investor and an outcome funder. Secondly, what is the regular rate of return these banks say when they look for to invest in non-development project, and what kind of return is justified for them when they are looking for a development project?
Yeah.
Vis-a-vis also, like what should the minimum ticket size that is encouraging for these outcome funders or risk investors to come?
Yeah.
The follow-up question is, it is easy to find risk investors rather than outcome funders.
Sure.
So how to bridge that gap?
Okay, so three questions. I'll maybe very quickly go through all three, and some of that will come in the learnings in the subsequent section. But maybe I think on the first one, education is a massive focus area for everyone right now. So in fact, I don't have the slide here, but if you look at the education space, I'll speak about one case study later. The education space is seeing a lot of a lot of activity from our results-based financing perspective, primarily because it has a very measurable outcome at the end of it, right, which is learning outcomes for students. So very strong interest, lots and lots of funders focusing on it and wanting to do stuff there. On the ticket size and returns, I think on the returns, I would say that it's difficult to say without knowing the context of the project. It depends upon what a project is able to actually bear. And also, I think important to keep in mind that the returns need to justify an uptick in outcomes. So, for example, from a philanthropic funder's perspective, if the returns are just a cost addition and the outcomes are not changing, there's no real benefit. So therefore, the returns, if even when you include that as part of the cost, need to that incentivization should lead to much better outcomes. But there's no sort of single answer to that returns question. And I think yeah, you spoke about outcome funders and risk investors. I think especially we are focusing on education. I think there are a lot of funders who want to fund the space. I think it's not a question of whether there are funds available or not. I think often the challenge is in actually structuring these transactions and then the time and effort that it takes. And I'll talk a little bit about those challenges later. So maybe answering your questions really quickly, happy to have a longer conversation later because there's a little bit more ground that we would cover. I think there's one more question here and then I'll continue.
Reference, the earlier page, when you have the bar graph, the TA percentage shows 23.6. Yeah. Is there a explanation for that?
Yeah, it's a little bit of a so the way to think about this is that if TA, for example, is loosening just a specific constraint. So, for example, if TA is helping non-profit partners develop systems which then allow them to raise substantially more capital, then that is very high leverage. So, I think the TA that has been taken here is typically catalytic. Behind that. To loosen basically what you might call binding constraints to them getting a lot more capital. And that I would take that with a little bit of a pinch of salt because of two reasons. I mean, this is from a specific report which is also available online, which was recently published. Because the number of transactions that include this kind of an element is not very large. So therefore, I think it will probably average out a little bit as you go forward. But the explanation is that it is basically for this.
The second question is there some kind of a permanent capital vehicle thought behind this also?
It's getting there. I would say I know that folks here who Archish, for example, has worked with Samrid, which is a blended finance facility. So there are facilities which are being set up. It is not permanent. These are typically long term, which try and do multiple transactions. However, those facilities exist. However, I would say it's at a relatively early stage right now. It is there are conversations ongoing, and I'll talk a little bit about how the government is trying to facilitate some of these transactions through the social stock exchange. Now, if that does take off, then that provides a vehicle through which permanent sort of funds, etc., can be set up, akin to what you might see more on the commercial side.
Thank you.
Wonderful. Okay, last one for now, and then I'll probably proceed. Yeah. No, go for it, please. Yeah. Yeah.
In terms of the underlying risk return characteristics of the project, do you think one sort of financial vehicle is more amenable, and how do you position to map out the best tailor the best financial vehicle to the sort of underlying risk return profile of the project?
Yeah. I think that goes to the root of it, to the root of a lot of the work that we try to do as well. I think it is, and then maybe I'll just flip back to a comment which I didn't talk about, but is a really important one, which is right at the bottom of the page here. I think it's important to recognize that blended finance offers tools and frameworks, which are it's essentially it is not the only funding solution, right? It is there are a large number of projects, a large number of sort of developmental causes which deserve capital and deserve a lot of capital, but might not be right for blended finance. So I think very often we hear from people that okay, we want to try out blended finance. I think and usually my response is that it should always be the reverse. You start from what is the need of a particular developmental cause, and then build from there. Yes, a number of these structures are there which allow you to sort of lessen the time that you need to develop all of this. However, it has to be tailored to what the cause actually requires. Over a period of time, as you learn more, then you can start consolidating, standardizing, as I think the gentleman here was talking about as well, to try and see if you can get more scale. But it has to be tailored initially. I think we are at that stage right now, where, for example, in sectors like education, there is now, for example, we, after we worked on an impact bond there, we got to something called a rate card. So now we have an understanding of what is the pricing of a particular education outcome from a learning outcomes perspective. We haven't been able to do that for social emotional learning, for example, but from a literacy and math and technical learning outcome perspective, there is a rate card. However, other sectors are still sort of at an earlier stage of evolution, so I think they'll get there. I hope that answers your question. There isn't like a standard response to this. Okay, thanks a lot. What I'm going to do is I'll probably move on to the next section, talk a little bit about the learnings that we've had from the implementation of some transactions that we've worked on, and then again I'll pause maybe for more questions after that. Thank you. Okay. So as I indicated previously, what I'm going to do as I talk about these learnings is to actually focus on a particular instrument. So we'll focus on results-based financing and talk about the learnings from there for two reasons. One, simply because I've spent a lot of my time in this particular sector rather than others, but also because I do think a lot of the learnings that we have here are extendable to other instruments as well. Maybe a quick 1 minute on what results-based financing refers to. I've already spoken about this, but these are structures that are aimed at basically changing capital flow from philanthropies and for public capital for payments to be made upon achievement of outcomes. So there's a very sharp incentivization of the achievement of outcomes. So for example, for the skill impact bond that I just discussed, the incentivization is to achieve job placement and 3-month retention in job outcomes. For the education impact bond that I spoke about, the focus is on achieving student learning outcomes. There's very specific incentivization for the achievement of particular outcomes. However, because for non-profits the money comes upon the achievement of outcomes, there's a need for someone to provide working capital. That is where private capital actually plays a role. And private capital ends up taking on the risk of outcomes delivery and therefore gets a return for it. Just a couple of examples of the impact bonds that have been implemented. I already spoke about the skill impact bond before. I won't spend a lot of time here, but just touching upon a couple of structures. Quality Education India Impact Bond was a $11 million impact bond implemented with a focus on educational interventions. Again, this was one which Dalberg was a part of. There were 4 non-profits which worked on direct educational interventions for 4 years with the objective of driving learning outcomes for students. So the payments that the outcome funders, in this case MSDF, the Dell Foundation was the big outcome funder there. They paid UBS Optimus, which was a working capital provider, upon achievement of certain targeted student learning outcomes. Another example here is of the Haryana Early Literacy Development Impact Bond. This was an entirely CSR funded impact bond, which was implemented over a couple of years in Haryana by LLF, and similar sort of structures. I think the outcomes that they had here was literacy for grade 1 and 2 students and some government capacity building. As you can see at the bottom of the page, both of these have driven fairly strong outcomes. So in Quality Education India, vis-a-vis a control group of schools, the outcomes that were driven were close to 2x when it comes to learning outcomes. Similarly, when you look at the LLF impact bond, about 3.5x outcomes were driven. So fairly strong outcomes have been driven for both of these instruments, and we are seeing similar strong results for the skill impact bond that we are implementing right now as well, though that hasn't yet fully gone through its life. What I'll do is I'll just spend a few minutes talking about what are some of the early takeaways and some of the early learnings that we have gotten from the implementation of these bonds. So starting maybe from the first one, as I just said, I mean the incentivization towards outcomes achievement seems to have worked. As I mentioned in the Quality Education India Impact Bond, we saw 2x learning outcomes vis-a-vis control schools, and this was a fairly scientific setup with fairly strong monitoring and evaluation standards. When we look at the skill impact bond, early results indicate that we are seeing retention in job, and this is for women, at being 2 to 3x, and these are conservative numbers. The numbers will probably be even better. we are seeing 2 to 3x kind of outcomes being delivered. So that incentivization seems to be working, I think is the key message. The second outcome, which is maybe a little bit nuanced, but an important one to point out, is that because in these structures, philanthropic donors are focusing on the outcomes. They are not necessarily focusing on the activities to be funded, right? So therefore, this funding for the non-profit partner becomes flexible funding. They have the ability to determine where they want to spend it. They have the ability to innovate and sort of target. Basically, they need to achieve particular outcomes that have been set, and they not only need to achieve those outcomes need to be measurable. So therefore, what we have seen is that there has been substantial iteration and innovation of models, which has led to sort of development of best practices, etc. Just to give one example, there's an example here of the Educate Girls Impact Bond, where it was a 3-year impact bond, the first ever implemented in the country. In the first 2 years, outcomes were subpar. However, the team was able to work, innovate, iterate, and deliver substantial outperformance by the end of the 3rd year. For the skill impact bond that we are implementing, for example, one of the big sort of things that some of our implementation partners are driving is how do you get women into manufacturing jobs, or increase the proportion of women who go into shop floor manufacturing jobs. And because the capital that they have is flexible, it's not necessarily tying them down into particular activities. They are able to do that and are delivering some fairly strong outcomes there. So that flexible funding story is the second one. The third learning here is around how have implementing partners responded. So there has been a fair bit of concern around this particular aspect. Whenever I was presenting a similar sort of a slide about a month and a half ago at another conference, and a big conversation was around is this kind of a structure really making it challenging for small implementing partners. What we have seen so far, and these are keeping in mind that these are early learnings that I'm talking about. Implementing partners have innovated. They have been able to adapt. Yes, there's been a need for investments in systems because there needs to be better reporting. There needs to be measurability of everything that they're doing, etc. There needs to be an ability to very accurately price stuff. However, we've seen non-profit partners respond really well, and they've been able to orient towards the outcomes that needed to be achieved, and have delivered fairly strongly. Of course, there have been challenges. I mean, this is not to say that it has been a smooth ride for everyone, but in general, the story has been pretty strong. And finally, I think the last one is more of a trend for the future, rather than something that we have necessarily seen in the past, or something that we are seeing with the new transactions that we are working on right now, which is that we are beginning to see a move from very direct interventions to systemic change. Funders and donors are beginning to come to us and say, okay, now you worked on a number of impact bonds. Now the next one shouldn't be focused on a few schools in a few states, or focused on a few training centers with a few organizations, but should be looking to transform the system. It's a much more challenging endeavor because it's difficult to measure systems change, but that's the push that we are beginning to see. So these are some of the emerging learnings that we are beginning to see in the ecosystem. And on top of that, I think so while these were, I would say, more programmatic in nature or linked to specific stakeholders, if we think about the ecosystem itself, there has been substantial learning over the past decade or so around what it takes for these transactions to succeed. Someone put it really nicely that I was at an event before where they were talking about how the question was, it's been 10-15 years. Why does it still take so much time, and why is it still super complex for us to implement these transactions? However, when you compare it with how for example, the commercial investing space has moved, it took 70, 80 years for equity or debt or something to become simpler, and learnings along the way and systems development along the way helped. So over the past decade, which is still a long enough period of time, there's been a lot of learning. There has been, though one of the big sort of criticisms of blended finance and any such instruments continues to be that they're expensive and costly, which is true. However, learnings over the past decade have helped people get a much better understanding of what works, where this works, should we even be spending time on it in certain sectors. There's a better, sort of more nuanced understanding of where investments need to be made, etc. And also the governments sort of started doing a lot more. which I'll talk about. I'm going to skip this one. Maybe I'll just cover the couple of slides and then spend the next 10 minutes answering questions if that's okay. Yeah, so talking a little bit about the future and to touch upon where this seems to be going. There is, as the lead line says, the direction of travel is clear. There is a lot more scale which is expected to come out of this. There's a lot of impatience that we see amongst donors who've now participated in a few transactions that this should scale up. And there are a number of initiatives which are supporting that. So there's increasing focus from the government. There is a sustainable finance working group within the Ministry of Finance, which is looking at blended finance. The social stock exchange is being set up. So there is a fairly, there are a fair few tailwinds that we are seeing on the development of the sector. And the fourth one I think is important to highlight, something that I spoke about, which is that there's a movement from bespoke transactions to funds, to standardized structures, to standardized price lists for outcomes, etc. I've spoken about a few of these, but these are some of the challenges the sector continues to deal with. However, there are, while there has been forward progress. The top one, the complexity and cost one, is probably the most important one, and the one that everyone really talks about when they talk about blended finance, that it takes a lot of time, it costs a lot of money. Is it worth it? And I think one question that I didn't answer from the gentleman there was around, is there a minimum scale? And yes, I mean, if as you talk about blended finance transactions, if there isn't a minimum quantum of scale, then the costs would seem really high. So for example, if it costs you a few $100,000 or $1 million to structure, then you need to at least have 10 to 20 million dollars at the other end of it for it to make sense. And as the quantum of capital goes up, as funds are formed around blended finance, the cost, of course, will seem smaller, but as there's more learning, complexity will reduce as well. There are a number of other challenges, not spending a lot of time on this, but just to highlight that these continue to be areas where a number of ecosystem actors are focusing. The Impact Investors Council with the Indian Blended Finance Collaborative is spending some time on, for example, finding ways to improve engagement, creating a data ecosystem. There are initiatives underway to help sort of create better knowledge management within the ecosystem. So these are some of the significant thrust areas that will hopefully help the ecosystem scale. Yeah, I'm just going to leave this here. I think this speaks to some of the initiatives that I indicated on the previous slide. So that's about it from me in terms of a structured presentation. I understand from the team that we have about 10 minutes or so. So I'm happy to take any questions that anyone might have, but also happy to add more based on my experience. Sorry, yeah, so it's maybe there and then here. Yeah, I think that's a great question, and I think that is an important next step. So there are some platforms. So there have been some initiatives where narrow platforms have been created. Let me put it that way. I think those platforms are focused on particular causes or particular sectors. However, they also tend to lock in the funders and the consortium up front. However, I think that's a really important point. I think what needs to happen next, hopefully facilitated by the social stock exchange, is to have platforms where which are evergreen in some ways, right? Where people can come in and go. And I think that potentially is the direction of travel. There are conversations that I'm or Dalberg is a part of where these things are being considered, and would be a really welcome sort of addition to the sector.
Yeah, hi. My name is Bhavya. I just wanted to ask about, so I want to touch upon the social stock exchange in itself. Could you tell us how exactly non-profits can sort of leverage different instruments on it? Because so as far as I am aware, there's the zero coupon sort of instrument. but which effectively functions as a grant, more or less.
Yeah.
So how is it sort of expanding the blended finance or like financial landscape for non-profits in India?
Yeah.
And yeah, just another sort of question on how do we sort of how do non-profits sort of begin this initiate the effort towards, let's say, seeking out blended financial instruments?
Yeah, no, I think both excellent questions. Maybe I'll start with the second one because I'm not fully an expert on the first one, but I'll try and attempt to answer that as well. I think on the second one, that is a fairly significant challenge right now. That consumers or recipients of capital uh, typically find it really difficult to initiate blended finance transactions, primarily because it's expensive and it's complex and it shouldn't be the role of nonprofits to be spending money on structuring or creating transactions unless there's significant funder and interest on the other side. I think I think that just going back to the platforms point, there potentially need to be platforms which enable things of this kind, and hopefully more will come up. At this point of time, I think the pathways are more around can you engage with donors who already have an understanding of your operations, of the funding ecosystem, to figure out if you can get initial experience, because the experience and being able to set up the systems which allow you to actually get access to blended finance is really important, right? So as someone who has helped philanthropic organizations find nonprofits, one of the big things that we look for is that, okay, is there a big investment in systems required? Is the culture oriented towards outcomes achievement, for example, or not? So a lot of a lot of that can be done without a lot of that preparation to accept blended finance can be done without actually getting into blended finance transactions itself. And then I would say that working with the donor ecosystem to sort of first garner interest and then get into the structuring of transactions would be the pathway. It shouldn't be. I think what tends to often happen is that a lot of money is spent without there being visibility on the transaction on the other side, which I think is part of the challenge, right? Because it tends to get quite expensive. So figuring out whether there is capital available and then getting into jointly structuring it might be a better sort of pathway towards being able to do that. But it is, I mean, this is while acknowledging that at this point of time it is really challenging for non-profits to, or a single non-profit at least, to do it by themselves. So that is number one. And on the social stock exchange question, I'll very quickly respond. I think what the social stock exchange does, I mean, right now it's one instrument and there are very few pathways. I mean, there is, however, there is at least based on recent conversations with them, there's a lot of talk around how the AIF regulations, etc., can allow for the setup of funds, which can then be listed on the social stock exchange. So that then offers a fairly transparent pathway for accessing funds, where blended finance right now can only be done by large philanthropic organizations with a lot of capacity. That the social stock exchange, if funds were to be set up, opens up a pathway for small or philanthropies also to potentially participate, and that expands the pool of capital available through there. However, my at least hope that I have is that with some of the initial experimentation, we will see a lot more coming up in the future in the form of instruments and approaches. I think currently it is at a fairly early stage.
Thank you.
A couple of questions that maybe there. I can just take a couple of questions more and then, is that okay? Yeah. Right. Yeah. 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 Sure. Sure. Happy to answer. Maybe I can also take the question there and then I can respond to both. Yeah, fantastic. Thank you. I think both wonderful. Okay, yeah, absolutely. Go for it. Absolutely. So I'll very quickly respond to, I think, all of these. I'm happy to have a longer conversation around that. I think just maybe first starting from the question that you had. In Educate Girls, the focus was on expanding enrollment for girls. There was a small learning outcomes component. However, as I mentioned before, I think these instruments respond very strongly to incentivization for particular outcomes. So Educate Girls was more focused on how do we get more girls into schools. There was a small learning outcome element which was also emphasized, but it was more focused on that. The quality education India impact bond, the other one that I spoke about, was more on quality. So it was looking at how do you improve learning outcomes vis-a-vis a control group. So I think it depends upon what the donors are looking for and what you want to really incentivize, and that is how MEL frameworks are developed. Um, I think that I think what you said begs an important sort of conversation between donors around how do you coalesce around a set of outcomes that everyone believes are important, which hasn't happened yet. So I'll maybe pause there on that particular question. On the systemic one, I'll maybe take two questions here together because I think you spoke about sustainability. There was a question around systemic focus as well. So that's exactly, I think, the driver behind why donors are now wanting to focus on impact bonds that are systemic in nature. Because what they've said is, look, we've tried this out. The concept works. There's a proof of concept which exists. Now, how do we take that learning and apply it to the system? Can we actually do it? And what you said, ma'am, is exactly the challenge. I think how do you measure systemic change is what we are grappling with on a couple of transactions that we are working on right now, which is uh, also when you're thinking about systemic change, you don't want to be narrow. A number of these instruments do force you to be narrow. So therefore, I think the conversation is that should systemic change, at least a large part of it, be more grant focused, and then there are specific elements that you try and incorporate into an impact one. There isn't an answer yet, but it is good that exactly is going to be a big challenge that we encounter in the future. But if we are to think about sustainability of impact, what we've learned is that dissemination of learning, sharing best practices works to an extent. However, unless you influence the system, it is not as sustainable as you might want it to be. In certain sectors, it might be possible. In certain others, you might need to think about hybrid models. So that was, I think, on those couple of questions. I think coming to the question that was around community participation, um, so far we haven't. So we've seen examples of blended finance instruments where uh, you know it's not the community directly, but individuals might have participated. So from a livelihoods perspective, for example, where there's a willingness amongst the learners to actually take soft loans and finance part of the instrument. But community participation has been tried out. However, I haven't really seen, at least in India, I'm thinking if it has happened elsewhere in the world, but I haven't really seen in India a strong example of where community has come in as a financial party. However, I think it has been tried out in a couple of cases. I know that in one case in agri, there was an effort to try and see if there could be cumulative outcomes which could be looked at from a community perspective. However, I think with the complexity of the structure itself, adding on that element probably didn't work in that case. But we haven't seen a lot of it. But it's an important, again, area. Just going back to the sustainability point that we potentially need to push towards. Again, happy to have a deeper conversation around it. But I think that's broadly the landscape here. And finally, realizing I'm out of time, maybe responding to the last question that we had around why is India sort of a favored market. I think there are a variety of reasons, and then at least from my perspective, I think one that it is also linked to the impact investing ecosystem having taken off. Actually, maybe even before that, one of the things I'd emphasize is that impact bonds in developed markets have been a reality for a long time. So if you look at the 300 odd impact bonds that have happened globally, about 270, 280 have happened in developed markets. with the UK being the pioneers. About 80-90% are outside of the country. In fact, in India, we don't see SIBs where the government is the outcome funder. That hasn't really taken off yet, which is a reality in the rest of the world. But the reason why this market itself is taking off in India is, I think, one, because there is the capital markets here are relatively deep. We have a fairly vibrant and high capacity impact investing ecosystem. So, and we also have a vibrant and high capacity philanthropic ecosystem, which is willing to participate. That's number one. Number two, it's potentially tied, I think, just to how some of these specific areas. The areas, if you look at the areas where impact bonds have been implemented in India, those have been in education, now in livelihoods, and a little bit in health. It also has been around how some of the large funders in India or the pioneers in India have coalesced around particular outcomes. There has been a little bit of a ecosystem effort which has been put in by donors like the Dell Foundation or SIF to try and figure out, do that initial work to figure out what are the kinds of outcomes which might actually work from a blended finance perspective, but also what might be valuable from a philanthropic perspective. So I think those are the two that immediately come to mind. There are a lot of headwinds. I mean, in fact, if you look at it from a regulatory perspective, the complexity is fairly high, and with evolving regulations, it keeps pushing the cost and the complexity up. But I think the quality of the capital markets we have on both sides, and I think efforts by a number of sort of innovators and pioneering organizations have been. Wonderful. I'll pause here. Happy to continue conversations. Thank you all very much for being a patient audience. I hope this was helpful. And thank you. Thank you very much.